And we're going to go to fellow investor first. And then, of course, Robert has a similar question. Fellow investor, when exiting a credit and debit spread that are listed separately in a Fidelity account, do you need to sell the legs separately as they do not appear to list both legs together? My assumption would be yes. I understand what you're saying. Okay, so he's saying that in the Fidelity account, when he does a bull put credit spread or a bull call debit spread, they don't link them together. Okay, I have an IRA account at Fidelity. I get level 3 trading, so I don't trade my spreads there, but I see the same thing on my married puts. I've got a long stock, a long put, and a short call. They're not linked together. So if I want to exit it all at once, I have to close 3 individual legs. So I'm going to say that yes, in that case, with the Fidelity account. Oh, sorry, folks. With the Fidelity account there, you'd likely have to liquidate both legs. Now, I'm not sure. I don't use this, but Ernie does, and I'll have to check with him in that case. And what I mean by that is he has the Active Trader Pro. I don't. That field or that upgrade where you can get the Active Trader Pro, I've just never bothered with it personally. I probably could do it. I should do it on Fidelity. But again, I'm just trading my married puts there. I'm trading my spreads in a different account in that case. I wonder if Active Trader Pro upgrade has a spread entry that's easier to enter and easier to close. I'm going to check with Ernie on that because I'm not sure if anyone has an idea. Anyone uses Fidelity and uses Active Trader Pro and uses spread positions, let us know. Let us help out fellow investor there to see if they have a better spread entry than the individual legs. And then if you exit it, is there a better way to exit the whole spread by itself other than the each individual legs? I will say this. If you are in a system and a setup where you can't find on Fidelity where to close the spread all at once for I apologize, opening it for a minimum net credit where that's what I do when I open, again, not Fidelity, but when I set my minimum net credit, in that case, it's at midpoint. Okay, when I have to close it, I try to close it at a debit that's equal to midpoint. In that case. So that's what I would look to do with that, if possible. Okay, and fellow just gave me a follow-up. He says, thank you. That Pro option does not work with an iPad Pro. I'd tell Fidelity to get on that. Honestly, I apologize. I'm not trying to be, kind of loose about this, but I would ask them, point it out, and I'm sure you have, but point it out to them again, and then point it out to them again, and just say, hey, your Option Trader Pro does not work with the iPad Pro. You should get someone on that. You should fix it. We should get that together. I'd really like to see that done. Okay. So in that case, that's what I'd be looking for. And of course, it might never hurt to check out another broker, if possible. I know there's been an upheaval recently, talking about Schwab and TD Ameritrade, getting merged together, buyout, and things of that nature. So TOS was bought out by TD Ameritrade, Schwab bought out Options Express, and now they're all going under the same hood together, apparently. But you've got Tastyworks and Interactive Brokers, Ally Trading is out there, E-Trade. I know they have a good spread entry field. Ernie's son Greg uses E-Trade, and I think they have a really good trade entry field and process also. So you can take a look at that just to open up a smaller account. And maybe do that there if you find it easier than trying to do each individual leg, of course, as well. All right. Member did have a follow-up question on the spreads, but we're going to go to Robert. He's been waiting patiently here, and he's got a direct question on a spread, and then we'll look at the follow-up prices as well. We might even answer the one question with the other. So Robert's question is related to vertical spreads as well, and it's on a specific trade. I bought a vertical put spread on GME. So it looks like we did a Bear Put Debit on GME, if I'm not mistaken. You bought the 200 and sold. I'm just going to stick with April 16th. Oh, that will help, won't it? Let's get the right symbol, Robert. All right. So let's just go to next week out. And you said we bought the 200. Sorry for the scrolling, folks. And sold the 185 put. and I was up 4 points on my trade with 3 weeks to expiration. How is that possible? Okay, let's just take a look at it. I don't know your prices. We don't necessarily need them. That's perfectly fine. So buy and sell. I'll use the current prices right now. And let's see. Okay. I'm just going to clear up these numbers so it's easier to see. There we go. Let's just put, I know it's cheaper, but we'll just put it that way to keep the numbers simple. Okay. So here we have a net debit of 1310 on a 15-point strike difference. And the max profit is $190. Okay. Now, as we know, GME has been, let's take a look at the stock chart. GME has been bouncing around. Had that, well, you were probably not in the bounce around time. I analyzed this during a coaching session last week. We were talking about a bull put credit spread potential. And I said, something that has this type of movement suddenly up and then suddenly down, and you're in the bear spread, I wouldn't be interested in the bull put potentially on this trade. Now it's below the SMA 20. I wouldn't even touch it. In any case, as a bull put spread, excuse me. That's just my criteria. Yes. Okay. So the stock has been falling down in this case. And we still have, oh, you did say 3 weeks to expiration, didn't you? You said 3 weeks expiration. So you're in the May, further out. My apologies. Other April. That's okay. So what I want to check out here is two things. I'm going to go to this here. And I'm going to go to research, and we're going to go to option research. And this is for the sell option first. So in addition to the stock falling from where you entered the position, Robert, and highly likely these options still have some time value in this case. Let's see what our time value is right now currently. And so the volatility is still pretty high, of course, 1.7893. And yeah, time value is 4.3%. What I wanted to see here, look at this. This case, the implied volatility has been dropping significantly. It's the blue line. Oh, sorry, I should scroll down further here. This is the historical graph of these options. The implied volatility is the blue line. So we've actually dropped in half from 3.56 to 1.46. So it's still a fair premium, and it was up to $63. Oh, that's way back when. No, but it was up to $63 when the stock price was, at a different price, and now it's just been coming down and coming down and coming down, going to zero. Your long option is doing the same. And this is your short. I mean, his question really is that he means to say that the stock is so much below the strike. I thought I would have been up a lot more. Well, no. And the reason why is because they're both still holding that 4% time premium. Okay? Implied volatility is dropping, and it's dropping in your favor, but it's not near the bottom yet, and you're still holding a fair amount of time value for 3 weeks because of the higher implied volatility. So even though it's going the direction you want, it's still retaining a high time value. Even though the implied volatility is declining as you want, you're still seeing I'm sorry, that's the percent if assigned symbol, but it's the same as the percent time value of the bid and percent time value of the ask. So between the bid and the ask, you're right about a 4.5% time value remaining on the short option, which of course you have to buy back, which is going to be hindering the close price. Let's take a look at the long. Let's see what we've got there going on for the long. Is there much difference between it? Applied volatility is still relatively high. Not quite at its bottom. Time value remaining on this one is much lower, 3.1, 3.6%. Naturally, it's deeper in the money. You have less time value still remaining on this position. But what you are seeing, if we take the mid-range, let's call it, okay, 3.4 here, not quite. So we've got 3.4% on time value remaining on that long option, which benefits you when you go to sell to close it, Robert, to liquidate the position. But we're at about a 4.5 midpoint time value on the option you have to buy back. So we're at a 1.1% difference in time value to close the position. And it just hasn't decayed the way that you were expecting because the volatility is still high relatively. Low to where these options were a couple weeks ago. 1 week ago, even 2.43 on 330. And then we start getting below the 2s right around April 1st. Okay, so the volatility starts coming down and coming down. It's going in your desired direction. But again, because of the volatilities, the bid-ask spreads aren't too bad, honestly. And that's not too wide for this type of stock with almost a 200% implied volatility on it. But we know why it's there, even though it's deep in the money. Still a reasonable bid-ask spread in that case. So that's just the key, Robert. Something of this nature with high implied volatility. I'd say even if GameStop drops another 15 to 20 points next week, from where it is right now, it drops down to 138 sometime next week, you still might be looking at a discrepancy in that time value percentage between the short and the long, which might not mean you're getting as much profit as you expected. In this one here in the prices I use, my max return I'm expecting is 190 off of the 1310, a 14.5% return. Really good, right in the wheelhouse of what I want for a vertical spread 2 to 3 weeks out in that case. And that's what we're going to be looking for. So I think it's a good trade, but with these high implied volatilities, even though the IV is dropping, Robert, in the direction that you want to, in that case, you're just not seeing the profit position yet, but you'll start to get it also when you get to that as well. Hey. Okay, so Robert, this is a catch-22. And I want to take a look at it, and I'm thinking I'm going to use the spreadsheet. No, I'm not. 200 to 185. Let me go back here real quick for your follow-up question. Okay, and I'm sorry, let me just jot this down here. I'm sorry. In the money is 16%. So it's 16% in the money right now. Okay. Yeah, I am going to use the spread chain. I'm sorry. So Robert's follow-up question was, in this case, he says, so I would have had to buy a put spread with less time value to expiration, meaning only 1 week out or 2 weeks out instead of 3 weeks out. Well, yes and no. Would that have matched your criteria? Is your goal to get closer to the 50% or near 100% profit you were expecting on the spread early, or to get the full profit at the end? And if it's to get the full profit of the end, we were seeing about a 15% return on that position right now, the 185 to 200 I mentioned. But if you went shorter term, it might have only been a 6% return. Now maybe 7% return. So what's the trading plan? Is it to get that return faster, or are you hoping to close the spread that's 3 weeks out sooner at a 50% profit point, which would be about 7% from the 14.5, okay, 7.3%, the 14.5 I saw in that case. And that's what I want to look at here. So minimum net credit, I'm not going to worry about that because we're really just going to, we're going to look at the, I'm just going to look at debit spreads in this case. So the max debit, it could be 20. And in the money range, we're going to go 16%. And minimum return, I'm going to say, was 14, right? But we're going to scale that back. I'm going to go 6% to start. Okay. All right. And I don't want 65%. Oh, yeah, I'm going to leave that blank for now. Excuse me. I'll leave that blank. Okay. Oh. I'm sorry. I apologize for that. I changed everything that I wanted to do there. Percent in the money range. Let's submit that again. Okay, too many. Where was our range? 180. Oh, that's because it's down here. 185 to 200 on the Bear Put debits in this case. Okay, that's the one we were looking at. And that's for April 23rd. Now let me go to April 16th. 185, 200. Perfect. This has a debit of 1313, was 14.2% to close at 24. Yeah, okay. So that's a big difference. So this, I'm sorry, let's refresh. I was looking at the wrong column. I sincerely apologize for that. It's about a 10% difference. So what does that tell us, Robert? That tells us with that 10% difference, you would be able to close this for a lower cost right now, potentially. Maybe. But the spread is still at 1313 right now, where this one's down to 1210. but that difference in percentage return with the same strikes there is, in this case, it's a little bit lower because of that higher price, but it's the liquidation there that you're looking at is very similar. Does this have something? I haven't checked. Oh, they had earnings a week or two ago, right? Wasn't it? I apologize on that. So would you expect to see decay faster in that case? Yes, you would. Would you expect your options to go to intrinsic value faster in that case? Yes, you would. But now you have to ask yourself, was the starting return, Robert, for the shorter term trade equal to your targets for that strategy in your personal account? Okay, that's what we would have to ask in that case. There we go. That's for Robert, the question there on the GME Bear Put Debit Spread and the time value that we're seeing remaining in it, why he's not seeing the return that he's expecting in these cases.